All right, so you've gotten pretty good at reading the individual words of the market, the candles, the trend lines. But what if you could actually read the entire story? Well, today that's what we're doing. We are decoding the plots, the twists, and the turns that are hidden in plain sight, chart patterns. So here's our game plan for today. First, we're going to make sure your foundation is rock solid. Then we'll jump into how to read the market's story through patterns and, this is key, how to pinpoint that exact moment to make your move. After that, we'll add a professional's checklist for confirmation. And to wrap it all up, we're going to learn how to spot and sidestep those clever little traps that catch almost everybody else. Okay, first up, section 1, your foundation is set. Before we can even think about building a skyscraper, we've got to make sure that bedrock is solid. So let's do a quick check on the tools you should already have in your toolbox. Look, you already get the building blocks, right? You know how to read individual candles, you can spot trend structure, you use things like exponential moving averages to get a feel for direction, and you know how to identify those key price zones. Think of this as your toolkit. Now, we're going to learn how to use all those tools to build a complete professional trading plan. And that brings us right to the heart of it all. Patterns tell the story. Seriously, these are not just some random shapes that show up on your screen. They are the reoccurring plots in the market's giant narrative. And once you learn to read them, you can start to anticipate what's coming in the next chapter. And really, every story in the market has one of two basic plot lines. Continuation patterns are kind of like the end then of the market. They're telling you the current trend is probably just taking a little breather before it keeps going. But reversal patterns, that's the plot twist. That's the signal that the trend is running out of gas and is about to flip direction entirely. With this pattern, you can literally see the battle lines being drawn on the chart. In an ascending triangle, the buyers are just relentless, right? They keep pushing the floor higher and higher. Meanwhile, the sellers are holding a firm line up top at that resistance. This creates this incredible pressure cooker environment that, more often than not, just explodes to the upside. And you know what? The market absolutely loves symmetry. The descending triangle is the perfect mirror image of what we just saw. This time, it's the sellers who are getting aggressive. They're creating lower and lower highs, pressing down against a solid floor of support. The story here is exactly the same, just in reverse. Pressure is building, and it's pointing to a potential breakdown. Flags are another classic continuation story. I want you to imagine a big, strong, explosive move up. That's the flagpole. Then you see the price just kind of chill out and consolidate in a small, tight channel. That's the flag. It's really just the market catching its breath before it takes off again on another sprint in that same original direction. Okay, now for those plot twists, the reversal patterns. A double top is like watching somebody try to punch through a concrete ceiling. They try once and they fail. They step back, gather their strength, try again, and they fail again. That second failure is such a powerful sign of exhaustion, and it often leads to a really sharp drop. And of course, its bullish twin, the double bottom, tells the exact same story, but at a key support level, signaling a potential reversal to the upside. Now, the head and shoulders, this is one of the most classic reversal patterns out there. You see a peak, then you see a higher peak, but then the third peak is lower than the second one. That sequence is a huge red flag that the buyers are losing their momentum. The key level to watch here is what we call the neckline. That line of support connecting the low points. If price breaks below that, that is a very strong signal the bears have taken control. And the inverse pattern, as you can see, is just the bullish version of this exact story. So the pattern gives you the game plan. But just seeing a pattern form is not enough to just jump into a trade. You need a precise, specific trigger. And that, my friends, is where specific candle formations come into play. They are your green light. They're the signal to act. So for a bullish setup, what you need to see is a sudden, undeniable show of force from the buyers. A hammer candle, for example, looks like buyers just slammed on the brakes and completely stopped a price drop in its tracks. A bullish engulfing candle is even more dramatic. It literally swallows the entire previous red candle, showing an incredibly aggressive takeover by the bulls. These are your signals to get ready to go. And on the flip side, for a bearish pattern like a double top, you need to see clear signs of weakness. A shooting star right at a resistance level shows a powerful rejection of higher prices. A bearish engulfing candle shows the sellers just completely overwhelming the buyers. This is the market basically yelling at you, hey, the bears are in control now. All right, so you've got a pattern, and you've got a trigger candle. Now, amateurs might stop right there and jump in, but professionals, they add one more absolutely crucial layer, confirmation. This step is what separates a consistent strategy from just hopeful gambling. This right here, this is the mantra you need to drill into your head. The pattern gives you the plan, it's the roadmap. The candle gives you the entry, it's you turning the key in the ignition. But volume gives you the confirmation. It's the fuel in the tank. Without it, that car isn't going anywhere. So let's build this out into a real professional checklist. Number 1, does the pattern actually align with the broader trend? 2, do you get a solid candle close beyond that key level, not just a little wick poking through? 3, is there a big surge in volume confirming that there's real conviction behind this move? 4, does the price come back to retest that breakout level and actually hold? And 5, does a momentum indicator like the RSI agree with the move? Ticking all of these boxes is how you turn a good idea into a high-probability trade. And for our final section today, we have to talk about a hard truth. Sometimes the market isn't just telling you a story, it's actively setting a trap for you. And understanding this is absolutely key to your long-term survival. I mean, think about it. You follow your checklist, everything looks perfect, you take the trade, and then bam, the price just whipsaws back in the opposite direction. That's called a fake out, and it is specifically designed to trap retail traders who get a little too eager and jump the gun. So how in the world do we defend against it? The traps are always hidden right where everyone else puts their safety nets. I mean, just think about it. Where do most traders place their stop-loss orders? Just above an obvious high or just below an obvious low? The big players, they know this. So they will intentionally push the price just past those levels to trigger all those stop orders. This creates a massive cascade of orders, which is just liquidity for them, before they reverse the price and leave everyone else holding the bag. A breakout on really low volume is another huge, flashing red sign of a trap. So here's the most crucial point, and it's your single best defense. Are you ready? Be patient. Never, ever, ever enter a trade based on a wick that's just poking through a level. A wick is just a temporary little price excursion. It's the candle's closing price that is the final verdict. Waiting for that close filters out almost all of these nasty traps. Let's leave you with this one thought because it really ties everything we've talked about together. Big players move the price. Patterns can be used to trap retail traders. But confirmation, that checklist, that's what protects your capital. So from now on, the question you have to ask yourself isn't just, what pattern is this? It's, what story is the market really trying to tell me?